Hi friends, welcome to your YouTube channel. Today in our video, let's discuss about SIP investments, its benefits, and three major types of SIPs. I'll walk you through the calculations of expected returns based on the amount you have invested and the duration of your investment. So by the end of this video, you'll be able to fully analyze your SIP returns and its investing duration and customize it according to your own goals. So please make sure to watch this video till the end. First things first, what exactly is an SIP? Systematic investment plan. Just as its name suggests, it's a way of investing fixed amount of money in regular intervals. Think of it as a way of building wealth slowly and steadily without worrying about markets ups and downs. This statement will be able to clearly understand when we get into benefits section of this video. Also, let's quickly see what lump sum investment is. Unlike SIPs, in lump sum investment, you are investing a large sum of money all at once. We are not adding any money in any interval. Let's say you got a bonus or you have just cleared a savings pool and you decide to invest all the money at once. That's called lump sum investment. All right. Now let's talk about the benefits of SIP. First, we have got compounding. We all would have heard about this term compounding. It's a method of earning interest not only on the invested amount but also on the returns earned in the previous years. It sounds simple, but it has very huge potential. That's the reason it is often called eighth wonder of this world. Let's further understand it better with an example. Let's say on year one, I have invested 1 lakh rupees into an SIP. And assuming with 12% return, I'll be getting like around 12,000 as a return. So by the end of first year, I'll be having 1 lakh 12,000. So just for simplicity, I'll be assuming I have paused my SIP and haven't invested anything on year two. So I'll be getting written on what we have at the end of first year. So that is 13,400. By the end of second year, I'll be having 1,25,440 rupees. Assuming that third year also I haven't invested anything. Now it's the same formula that applies. I'll be getting written on what we have by the end of second year. Right? So 12% of it is equal to 15,000 rupees. So by the end of third year, I'll be having 1,40,492 rupees, right? The compounding benefit will be most evidently seen in long run. So initially, I have invested 1 lakh and it hasn't changed. But over time, my returns has been continuously increasing. And by the end of 24th year, I'll be having around 15 lakhs in my portfolio. Out of 1 lakh I have invested, I'm getting 15 lakhs. So compounding is a clear benefit when it comes to a long game. All right. The next benefit we are going to discuss is rupee cost averaging. Let me explain this concept with an example. Imagine every month I decide to invest 5,000 into a mutual fund. In the first month, the unit price of the fund is 50. So I'll get 100 units for my 5,000. Now let's say in the second month, the market spikes and the unit price now is 60. Now for the same 5,000, I'll get only 83 units allocated. In the third month, let's imagine the market takes a dip and the unit price drops to 40. This time, for 5,000, I'll get 125 units allocated. So by the end of 3 months, I have invested 15,000 rupees and I have accumulated 308 units. This 308 units is allocated at an average of 48.6 rupees. So even though I have bought units at rupees 50 and rupees 60 in the first 2 months, The unit price anything above this average, which is 48.6, is a profit for me. This concept is called rupee cost averaging. The next benefit we are going to discuss in SIP is that with SIP, we don't have to analyze the market trend. This is because with regular investments, we get benefited from rupee cost averaging. With rupee cost averaging, it will automatically allocates us more units when the market is falling and less units when the market is in rise, right? So this makes our strategy very less dependent on the market swings. So we don't have to time the market or analyze the market every time we invest in SIP. It is often said that SIP investments have very less risk compared to lump sum investment. Let's say a day you decided to invest 1 lakh rupees into your mutual fund. Next day, if the market crashes, your entire 1 lakh investment is at a risk. In opposite, if you decide to do an SIP, that is, you decide to regularly invest 5,000 or 10,000 every month into an SIP. So even if the market takes a dip, your investment is spread out over the time. So you're not exposed to full risk of the market crash. So in the long run, this strategy helps us reduce the impact of market dips. Now, the final benefit we are going to discuss in this video is flexibility. With SIP, we have both time-based flexibility and money-wise. When it comes to time-wise flexibility, you can decide how often you want to invest. Whether it's monthly, weekly, quarterly, yearly, it's totally up to you. Also, you don't have to stick to this rigid schedule. If you need to pause or skip a payment, you can usually do that without penalties. Now, when it comes to money-wise flexibility, if you start with 2,000 a month and later you decide that you can afford 5,000, you can easily increase your investment. Similarly, if you are facing a tight month, you can reduce your SIP amount or pause it for a while. Now, let's move on to types of SIPs. In this video, let's discuss about three major types of SIPs. First one is normal SIP. In normal SIP, we decide certain amount of money that we want to invest in and we stick to it. In the second one, which is step up SIP, we start with certain amount of money and we keep incrementing it year on year. Right? In step down SIP, instead of increasing, we keep decreasing year on year, which is called step down SIP. Now, let's get into the details of normal SIP with calculations. Okay. In this example, I have taken 50,000 monthly investment and to a maximum of 20 years. And across all the types, I'm using the returns of 12%, 13%, and 15%. I'm assuming the base as 12% because even if we choose an index fund, it will easily give us 12% in a long run. Again, this is an expected return but not a fixed one. It can slightly vary as well. But it shouldn't go down below 12% because it is closely tied to India's GDP. If we are positive about India's growth, then yes, 12% is what we can expect in a minimum return. Okay. So I started to invest 50,000 every month, and for me to get the first CR, it will take me 10 years with 12% interest. And for my next CR, it takes only 5 years. And for the next CR, that is 3 CR, it takes only 2.5 to 3 years. And for the next CR, which is 4 CR around in total, it takes me another 2 years. So total by the end of 20 years, I can expect a return of 4.3 CR with a 12% return. Similarly, with 13%, I can expect like around 4.8 CR, and with 15%, I'll be getting 6.1 CR. Now let's talk about step up SIP. Let's say I choose to invest 30,000 every month in the first year, and I wanted to increment it by 10% every year. So in the first month, I'll be investing 30,000 and I'll continue doing that for the entire year. And in the second year, I'll be incrementing 10% of what I have been investing in the first year. So that is 33,000. And in the third year, I'll be increasing 10% of what I have been investing in the second year. So that is 36,300. We all would have heard in Instagram or many other financial videos that with step up SIP, we can maximize our returns up to 2 times or 3 times. Now, let's actually analyze the fact behind it. Okay. The statement is actually true, but I start with monthly investment of 30,000 rupees. And by the end of 20th year, I'll be investing a whopping amount of around 1.8 lakhs every month. Now, the question is it really practical? It can be for few, but we'll have to think if it is affordable for us. When it comes to returns, for us to achieve our first CR, it takes like around 11 years. And for the second CR, it takes like around 4 years to achieve. And for the third CR, 2 years, fourth CR around 1.5 to 2 years. And here is the magic. In the from 19th year to 20th year, we are gaining around 1 CR in just an year. Here, our monthly investment is increasing. Similarly, you can see the values depicted for 13% and 15% returns as well. Now let's move on to step down SIP. Let's say I wanted to start my investment with around 1 lakh rupees every month, and I decide to decrement it by 10%. So initially it is 1 lakh rupees every month for an year, and from the second year I'll be decrementing it by 10%, which is 90,000. Third year I'll be decrementing 10,000 on what I have been investing in the second year, which is 81,000. And when it comes to 20th year, it will be like around 13,500 is what I'll be investing every month. When it comes to returns, I'll be able to achieve my first CR in the 8th year itself. And the second CR is in the 13th year. And third CR in the 16th year, fourth CR in the 18th year, and fifth CR in the 20th year. Now, let's compare all these three types of SIPs with respect to numbers. The total investment I have made in normal SIP is 1.2 CR. And in the step up SIP, I have made like around 2 CR. And in the step down SIP, I have invested 1 CR 5 lakhs. When it comes to returns, for 1.2 CR I have invested in normal SIP, I got returns of 3 CR, 3.1 CR to be precise. And in the second one, which is step up SIP, for the investment of 2 CR, I have got like around 3.1 CR. And in the third one, which is step down SIP, for 1 CR I have invested, I have got the returns of around 4 CR. So, clearly by number, step down SIP is more beneficial because the more amount of time we give for our money to grow is the more we get in terms of returns. By numbers, we can see that step down SIP is clearly beneficial, but there is also a use case where step up SIP is beneficial. Let's say you're a recent graduate and who just started a job with a graduate level salary, and you're expecting growth over years. Or you're a business owner who wants to reinvest your profits into your business to grow. And initially, with respect to investments, you want to keep it low. In those cases, you can start with as much as you have at this moment and keep on increasing it as your business or your salary grows. So, let's see here For us to reach this 1 lakh monthly payment, I mean monthly investment, it takes 14 years in step up SIP. But this 1 lakh, we are doing it right from the starting in step down SIP. Well, if we think to start at the 14th year with 1 lakh investment, in that case, we'll be missing out on this 1.6 CR, which we have accumulated over these 13 years, right? So instead of starting late with more investment, just start early with as much as we can. That is clearly beneficial. Like we all said, as the time, as we give more time, we can expect more returns. So try to invest as early as possible. We'll be sharing this document link in the description below. You can easily make the changes in this document according to your investments. Let's say if you are investing like 30,000 in a normal SIP, just give 30,000 here and you can see all the numbers getting changed automatically. Similarly, in step up SIP as well, just if you want to start with 10,000, just give 10,000 here, and if you want to increment it by just 5%, just give 5 here, and all the numbers will be changed. Equally, if you want to start and step down SIP with 50,000, just give 50,000 here, and you want to decrement only by 5%, just give 5 here, and you can see the returns expected. And similarly, the differences will also be edited accordingly. Take it as an exercise. Just give numbers according to your investment types and see the profits or returns expected over the years. Thank you for watching. I hope you liked the video. If you are interested in similar content, please do like, share, and subscribe to our YouTube channel. And if you have any queries, please post in the comment section below.